Hello everyone and welcome to today's webinar, the nuts and bolts of making money as a private lender. This is professional real estate investor David Campbell from HassleFreeCashflowInvesting.com, and I am joined by my good friend and mentor, Ken Gain.
Morning, David. Well, I guess it's afternoon down there. It's still morning in Alaska.
Yes, to the miracle of technology, I am presenting today from the beautiful San Francisco Bay Area, and my good friend Ken is looking over a beautiful lake in the great state of Alaska, and we're able to meet up with all of you who are all over the world enjoying this great content. And while Ken and I are in different states and we're licensed in different states, a lot of the ideas that we're sharing are universal in their application. But we always encourage you to understand your state-specific laws as well. So while we're on the topic of private lending, we just want to understand why we're offering this free event, and just let it be known there's nothing for sale. There's not a sales pitch. There's no upsell in this. This is pure content. Ken has been practicing real estate continuously longer than anyone I know, and he's really enjoys giving back to people and sharing, and the same with myself. I really am a teacher at heart. I love sharing good content, good ideas, and ultimately an educated client is a good client. And so ultimately we produce events like this just to introduce some ideas, introduce opportunities that you can make money as a private lender, and a relationship if you ever decide that you want to be a borrower of private money or a lender of private money. Just to make the community aware that Ken and I exist. That's the whole point of today's event. Big disclaimer, you can't sue us because of your actions. This is not tax advice. This is not legal advice or investment advice. We're not making any representation that what Ken or I say is accurate by any means. We're just sharing some ideas. And before you take action, really get the help of qualified advisors for your specific situation. And also, Ken and I are different people from different companies, and our ideas might be different. And there's no client relationship or fiduciary relationship created simply by you watching this video. So we have all the boring stuff out of the way. Let's get into some meat, because we're all here to learn today. And one of the overriding concepts of hassle-free cash flow investing, which is my company, is helping clients improve their return on investment by having less time, less money, and in some cases, less time and less hassle, and in some cases, less money invested. Because the less time and less hassle you have invested, the more passive you are, and the higher return you can get on your investments. And that's one of the reasons we're talking about lending today, because it's possible to make very high rates of return as a private lender without some of the hassles associated with other types of investments. So we're going to go through a couple basics, and then we're going to get into some very hands-on to-do lists or hands-on ideas on how to be successful as a private lender. The basic idea between equity and debt is the equity is the most at risk. For example, the owner of a property has a deed to the property. They're the owner, and what they've contributed is equity. They're the first one to win, and they're the first one to lose, right? That's the equity position. The debt is to the borrower is a liability, to the lender is an asset, and that debt is secured by a deed of trust against the property, and so that property becomes collateral for the debt. And it's important to know the difference between equity and debt, because they both have different advantages and disadvantages. From the lender's perspective, the note that you have is a negotiable asset, right? If you the piece of paper in your wallet that says dollar on it is actually a note from the Federal Reserve, where the Federal Reserve Bank has given you a promise to pay. That is an asset to you because you're the holder of that instrument, and it's a liability to the bank that issued that dollar, right? So that same piece of paper, that note, can be an asset or a liability depending on how your relationship to that particular asset. One of my favorite maxims about being a lender is a lender should be happy if they get repaid as agreed, which means you pick an interest rate and terms that were acceptable to you. And you should be even happier if you don't get repaid, because then you get the collateral. And so oftentimes I hear people express that being a private lender is somehow risky because they're worried what will happen if they don't get repaid. And very oftentimes it's a gap in education or knowledge because they don't know how to go through the foreclosure process, or they simply didn't make a good loan at the beginning, because if they took the property back, they would be faced with a loss, right? So, Ken, you've been doing this for over 50 years, and uh, do all loans pay as agreed?
No, unfortunately, no, they don't. But as you point out, if you did the loan right, you can make money on getting the property back. Although I've taken losses on it because I didn't follow the rules, and that's why doing it right is very important.
Yeah, so the school of hard knocks has helped Ken become a better and better lender, and it's very exciting to be able to tap into his 50 years of seat knowledge. And at the end of this presentation, we're going to learn Ken's 10 commandments for being a private lender. And those commandments were created from decades of figuring out what works and didn't work. And we're all hoping that you can take advantage of that amazing uh, experience. So sometimes property goes up in value, and if you're the equity holder, let's say you bought it, for $1 and you sold it for $2, well, you did very well because your equity has gone up, a magnitude of 5 times when you use the leverage that's shown on the screen. So as the equity holder, you're very happy. As the debt holder, if you're the lender on that asset, you're also happy. One, because you're going to get repaid, and two, because as that equity goes up, your security improves. The more equity there is, the better you are as a lender, because you are hoping every day that they don't pay you back so that you can take title to that asset through foreclosure. So, in an appreciating market like we're in right now, it's exciting also to be a lender, because as prices go up, the borrower is more likely to repay. And some people want to be a lender to own the asset. I remember going into a meeting with a local lender that was not Ken, and I showed them my development project, and I said, here's what I want to do, here's what I'm going to put up for down payment, and here's what I'm going to cross collateralize with, and here's what my signature is worth, and would you do this loan? And I'm really happy this lender told me what he did. He said, David, we would love to do the loan because I think you're going to fail, and I want the property that you're buying at a discount because your down payment makes that property discounted for me. And so I would be making this loan in order to buy the property at a discount. Ken, have you ever?
That's called loan to own.
Do you ever loan to own?
No, I really don't. I just, I mean, I'm not saying you can't make money at it. Clearly you can, but I think it's kind of an ethical deal. If you think the deal is going to fail, I just won't make the loan. That's just kind of our rules. But I did want to make a point, what you talked about, the appreciation. Uh, well, the equity owner gets the advantage of the appreciation. It can sometimes also accrue to the lender. If you made a loan at, say, a 12% interest rate, and now the equity is doubled from when you made the loan, you can probably sell that loan to someone else at a lower interest rate and actually make a capital appreciation on the loan also.
That is awesome. Yeah, so if you made a loan at 70% LTV and now because of appreciation, it's 40% LTV, someone's going to pay you a premium to have that security. Yeah.
Usually what you do in those cases, because of no one wants to really pay more than face value, because if somebody pays off, that's all they can get. But what you can do is you can sell a partial preferred interest in it at a much lower interest rate, so you've got almost all your money out of it, but you're making a spread on what the other investors put up. And we've done that a number of times. And on a real good case, you can sometimes pick up a 4 or 5% interest spread. So
Yeah.
There is appreciation in debt, although not as easy or as obvious.
Well, sometimes prices go down, or maybe prices didn't go down, but the borrower failed. And I've seen this when there's not enough profit in a flip, or there's not enough profit in a deal for the borrower to complete the project. Or maybe they just took too long to complete their venture, and the interest cost ate up all of their equity and profit on the deal, or maybe the market changed, but there's all kinds of reasons why a borrower could fail in their business plan. And in this particular situation, if you bought it for a dollar and you sold it for 80 cents, in a foreclosure auction, um, the equity investor is not happy because they lost all of their equity. They had 100% loss. But in this example, the lender is just happy. They're fine because all of that equity disappeared. That's their protective equity. That's what's protecting the lender's investment in the property. Because as the property declines in value, the equity loses and the lender ideally gets repaid from the foreclosure sale. So then the idea, or the comparison between equity and debt, is an equity holder has a higher risk position. They've got a higher reward position, but they're also the property owner. So sometimes the property owner has more hassle dealing with the property, more time, and their upside reward is potentially an increase in equity or capital gains. On the right side, the lender has a lower risk position in the property. By that definition of having that borrower's protective equity, their position is lower risk than the equity player. Their reward is potentially lower, but sometimes it's possible that a borrower works really hard on their business plan, and the only person who makes a profit in the deal is the lender. I've seen that happen. Or the lender makes more money than the equity holder. But as a lender, there's definitely less hassle, less time involved in managing the loan than there is managing the property. And oftentimes, the lender, what they're making is cash flow. So the equity holder might make higher return on investment from capital gains, and the lender is making pure cash flow on the investment. You
David,
can,
a point on
yes,
that. One of the reasons I got into more lending, although I still do some equity investment, but I'm more on the debt side than the equity side. As I got older, I didn't want to work the 60, 70 hours a week anymore. And if you have a good loan, it takes about 5 minutes a month. You do the accounting, and then maybe once a year you spend 20 minutes reviewing that the insurance is renewed. Uh, so if you have a lot of good loans, you can handle 50 loans pretty easily, whereas if you had 50 houses, you'd have a lot of work. So uh, there is a real advantage in time.
there sure is. Oftentimes, when people are starting out, the young people take the equity positions because they have a higher risk tolerance, and maybe they don't have as much money. Right? Maybe what they're investing is their time. They're investing their skill. They're investing their other resources other than cash. And a good collaboration is between a borrower and a lender, right? If the lender wants that lower risk, lower reward, less time involved, more cash flow, that's a great collaboration because you need both to make your deals go. So this is the cash flow quadrant, and the left side is employee and small business, which is you're investing time, trading your time for money. On the right side of the quadrant is business investments, and to get out of the rat race, to become financially independent, you need your money and your ideas to make money, and that rather than trading just your time for money. And the right side of the quadrant, how I know that it's a business and an investment is for me, I want my business's investments to be passive. I want them to be reproducible, meaning if I can do it once, I want to do it 10 times. Like a loan, the idea of lending money is a reproducible concept. I also like lending to reproducible borrowers. If the same borrower can give me a steady source of loans forever, for example, I'm a developer and we build houses in Texas, and Ken is my lender. And as I build a house and I sell it, Ken gets paid off, but I am in the business of borrowing. And so he can make another loan to me. So as a repeat borrower, you're definitely leveraging your time, because the same amount of time to vet a business plan and to build a relationship results in scalability. You can get that relationship produce a higher dollar amount of loans, which is as an investor, the more loans you have, the more money you've got working for you. Also, I like that businesses and investments are outsourceable. You can take portions of the activities and you can outsource them. You can have people do the loan servicing for you. You can have an attorney do the foreclosure for you. You can have brokers bring you deals and paper the projects for you. You can have appraisers do the valuation assessments. There's all kinds of ways to leverage your time to make being a private lender very, very scalable, outsourceable, reproducible, and most importantly, passive, because we don't want to put our time in. Otherwise, the more time we put in, it lowers our yield. So Ken has been a great mentor of mine, and he has taught me how to be a private lender. So I am both a borrower and a lender. We broker loans, and we're also a direct lender, and we're also borrowers. And so I've been really grateful to learn these ideas from Ken. So, Ken, take it away on your 10 commit.
This is rule number one. I never added up how much violating that rule has cost me, but it has. But is never loan more on a property than you would be willing to pay to buy it for cash. And by that, I don't necessarily mean price and value, because, I mean, obviously that's important, but our worst loan, one we foreclosed on, we still haven't sold, so I don't know what the loss is going to be, but it's going to be substantial. I made a mistake of looking at the property based on an appraisal. The appraisal was a good appraisal, but it was a rural inn that the appraisal was based upon somebody operating it. Well, as a practical matter, when the loan defaulted, we couldn't find someone to run it. I sure wasn't going to move out there into the boondocks and run it myself. So the truth is, I never would have bought that property unless it was, such a low number that I knew I couldn't possibly lose on it. So I made a mistake there, because I made a loan on a property for more than I would be willing to pay to buy it. Even if it worked out, it was still a mistake, because it was a type of property that I had no capability to manage, and it's a small enough, specialized enough property to try to find an operator to take over is a problem. So in looking at that rule, take it in terms of price. It's a price you'd be willing to pay, but it's a property you wouldn't mind owning. So this sometimes affects your geography you're going to lend in. Now, that doesn't mean you have to do it in your own backyard, because you don't have to manage it, but it has to be a property that you can find someone to manage. If you have a loan on an apartment house or commercial building, almost anywhere in the country, you can find someone to manage it for you if you take it back. But in this particular case, where I made this bad loan by violating this rule, it's such a specialty property that we couldn't find anybody to manage it. We're sitting there. So that's the number one rule. If you follow that one, you're a long way towards success.
Yeah, I want to underscore something really powerful that you said, which was the value of the property that you lent on was the income the property produced. And without that income, the property had very little value. And that income was highly dependent upon an operator. And the type of property and location of the property, you couldn't find an operator to operate it. Therefore, your income disappeared, and then the value disappeared. So, that's definitely a huge consideration, is to figure out before you make the loan how you're going to manage the property when you own it.
Yeah, I think looking at a loan is looking at like you're going to buy it.
Yeah.
The second rule is never make a loan on an owner-occupied home. Now, this sounds almost counterintuitive from the reason that we know from banks, their preference is an owner-occupied single-family home. But when you're into private lending, it's really a very, very risky loan. The reason being is that virtually every state, and in fact, I think was the last state that started licensing mortgage brokers. And then part of the Frank Dodd legislation, they came out with national legislation which encouraged each state to adopt sort of a model act, and to my understanding, most of them have. And within that act, they also license lenders or require lenders on owner-occupied residential properties to have a license. Within the licensing provision in the model law, like I said, you need to check in your own state. It ties it back to the federal law, the Truth in Lending Regulation Z, and all of those types of and there's like 8 or 9 of them, which are very complex laws. And if you fail to dot every I or cross every T, you may have an unenforceable loan. Private lending, unless you're doing an awful lot of them, you're not set up to do it. But the other problem you have is you go into foreclose, and you've got to say a 10, 11% loan, and the judge sitting there is going to look and say, well, gee, I see where they're advertising this bank is loaning at 4%, you're getting at 11%. I'm sure this is a predatory loan. I don't know why, but I'll find a reason. And that is the real risk on it. I just had a friend who got sued. He made a loan to a lady who was going to lose her house, saved her home. The place was wrecked. He loaned her money, fixed it up. She fixed it up. She never made a payment on it, so he foreclosed. 3 years goes by, and the day before the statute of limitations runs, the Legal Aid Society came in and sued him and said, well, he didn't follow all of the federal regulations of disclosure of the true cost of the loan, and they were looking for recovery of the property and treble damages. Now, he settled it. I don't know what for, but it was a lot of money. Owner-occupied homes for private lending are just extremely risky.
Yeah, you feel like you're doing the right thing and you're helping someone out in the situation that they can't get. Um, they go to the bank and the bank isn't going to help them, and so as a private investor, you feel good about helping someone stay in their home, and there's a lot of emotions, right? When you're dealing with an owner occupant and it's their home, you call them and you say you have to pay or move out because that's our agreement. Um, it's very emotional for them because oftentimes they don't have anywhere to go. But on a tenant occupied home, you're dealing with an investor, and as the lender, you probably want the tenant to stay. So when you foreclose, you've got an income producing asset, and the tenant is paying the income. Because oftentimes, the reason that the property goes in foreclosure has nothing to do with the success of the tenant; it has to do with the success of the owner. And maybe the owner is overcommitted, or they over leveraged, or they took money out of property A to go use it into property B, and then property B failed, but your collateral is property A. When you foreclose on property A, you're going to want that tenant in the property to be continuing to make their rental payment.
Third one is to be sure to retain and heed the advice of an attorney experienced in lending law. There are a lot of legal documents involved. Now, like I say, if you follow rule number 2, you've made your job a whole bunch easier. But even getting into loaning on land and income producing properties, the laws of every state are different. I've always enjoyed being at a conference where 2 people get up and arguing about foreclosure, and you find out that they're from different states and they may be both right, but they'll argue about it because they see it one way, which is what their state is. So you have to have an attorney who really understands lending, and not just an attorney who might have handled a traffic violation for you, but somebody who really specializes in that area, and they will give you the advice that you really need to have proper documentation that's enforceable, be able to represent you in foreclosures, and hopefully you won't have to use them in foreclosures, but every now and then things happen, so it's always good to to have that as your insurance policy, an attorney who can help you through the whole process.
You were mentioning something about state specific laws, and that is such a powerful statement because there are some states, like California, which are single action states, meaning when you make a loan to a borrower and they don't pay, you have the ability to foreclose on the asset, but not the ability to sue them for a deficiency. And there are some exclusions where you can trigger a deficiency clause in California, but very oftentimes you get the property and that's all you get. Versus, say, Texas is an interesting state. That's where I do a lot of my business because it's a full recourse state. So if you lend someone $100 and it's secured by property, and then you foreclose on the property and you sell it at the trustee sale for $50, well, the borrower still owes you $50, and you can go and get a money judgment for that collection, and then you can go try to collect that extra $50 that is owed to you through a deficiency judgment against the borrower.
It's also one of the states where you can foreclose the fastest. I mean, some of the back east states take 2 years. Texas, you can foreclose faster, I believe, than any other state.
It is really fast. It's depending on the time of the month you decide to foreclose. It could be 45 to 60 days, and you've got title to the property. So the other thing about when you're retaining an attorney, sometimes the cost of the attorney can be prohibitive relative to the deal size, right? If you're trying to lend someone $10,000 and the attorney is charging you $1,000 to prepare and review your documents and consult with you, that's 10% of the loan amount just in legal fees. And typically, the borrower is going to pay the cost of the legal representation in preparing the loan documents, but maybe as an owner you need additional representation or just counsel that may or may not be something that you could pass on to the borrower. Ken, do you have any advice on what kinds of questions you have for an attorney, and maybe minimum loan sizes relative to loan fees that make deals maybe impractical because a loan that's too small relative to the cost of legal makes the whole deal not.
Well, in many cases, the small loans just don't make sense because there are regulations in certain states that, because of the usury laws, for example, in Alaska, we have a usury law, loans under $25,000. So we simply just don't make loans under $25,000. That's why you have to be state specific. But in working with an attorney, usually, you can get a standard package of paperwork that fits your needs. So they'll give you reduced costs on producing documents. But in selecting one, I find somebody who has been representing banks or better yet, even other private lenders, because you know that somebody else has paid for their education.
Yeah, that's important. That's important. The attorney in some states is going to prepare the title work, which is just as important and oftentimes more important than the loan documents, which is doing the title research and then issuing a title insurance policy or a lender's title policy. We'll talk about that a little bit later. But in some cases, what I've seen is the attorney makes a fee from selling the title insurance policy, and therefore they will discount their attorney fee pretty heavily because what they want is the profit associated with the sale of the title insurance policy. So if you go to a big title company, the title company or the escrow company might keep the title insurance premium fee, and then the attorney has to charge a high rate for their fee because that's the only way they make money, versus maybe a smaller shop where it's an attorney-owned title insurance company. Then you get a little bit of economy of scale because the attorney doesn't have to charge you for basically the cost of the premium. The title premium is subsidizing their legal fees in some cases. Number 4.
This licensing, I've talked about that earlier. Like I said, to my knowledge, in every state, if you're doing loans on owner-occupied residences, you have to be licensed, but most of them will allow certain exemptions. Usually, commercial and income property is exempt from licensing, but that doesn't mean it is in every state. So be sure to, you know, the attorney you work with, be sure to go over that issue so you don't make loans that require a license. The problem is that the penalties under most of these situations are quite severe. If you make a loan and you weren't licensed, you know, you can be a misdemeanor with a fine, you know, potentially even jail time, although rarely that's the case. But the big thing is the possible forfeiture of the total loan amount. So make sure that you have knowledge of what's required in your state or the state in which you're making a loan. One of the things we always do is we get an affidavit from the borrower as to the nature of the property so that we're certain that it complies with the exemption. So it sounds simple, but it's a very, very painful process if you violate it.
And again, these exemptions and regulations are state specific. So sometimes you can qualify for an exemption until you've done too many loans in that state, and then by crossing that threshold, however many loans that is, either it's quantity of loans or dollar size of loans, it could push you from just being an individual private lender who might be exempt into being a commercial lender that has to follow regulations. Another really important thing to consider in your licensing is whether the the interest rate that you can charge. For example, in California, if you're an individual making a real estate secured loan or mortgage or a deed of trust in California, if you do that from individual to individual, the usury rate is set very low. So you can't charge very much on your interest rate. However, if you make that same loan through a licensed broker, then that usury rate is lifted, right? So you can charge a much higher interest rate on your loan simply by using a broker who is licensed. The other thing to consider is fractionalized notes, where if you are putting more than one lender to own a note as tenants in common or to have some type of a joint ownership of a note, very oftentimes you're going to trigger securities laws and securities regulations because as someone becomes more passive in that note ownership, then it becomes a security, right? And that threshold can change on a state by state basis. And so just note that if you start dealing with fractionalized ownership of notes, that you may want to consult a securities attorney as well as a real estate attorney.
That's an important thing because you're right, it does vary. We have a private letter ruling from our security commissioner in Alaska, which allows us to have a certain amount of people in the deal, basically ourselves and one other person. And while it is a security, they agree it's not anything you have to register. So again, it's a state-specific thing and needs to be checked out.
Mm-hmm. And whether you're working with accredited investors or non-accredited investors could be a challenge. And sometimes people think innocently, I'm doing this, $1 million loan, and I'm going to let my friend's, daughter participate as a $1,000 investor in this $1 million loan. So she owns 0.1% of the whole loan, and that 0.1%, might screw up your whole deal because maybe that person is non-sophisticated, they're non-accredited, and they were just relying solely upon your expertise for the success of that loan. That's where you can get into some licensing troubles. But I really advocate if it's one borrower, one lender, that is pretty simple. And if you're not doing a lot of loans, usually you're not going to run into licensing issues when it's one borrower, one lender, and you check on usury requirements for your area. That puts you relatively in the safe zone. Number 5,
Yeah. Number 5, of course, is become knowledgeable. And I say knowledgeable, I'm not saying become an expert, because to be an expert, you're probably going to have to take up the practice of law. But have a pretty good understanding of the real estate laws, lending laws, usury laws, and foreclosure procedures in states in which you're making loans. And the usury laws are the tricky ones. Almost every state has some form of usury law where they say you can't charge over a certain rate of interest. But you also need to know how they calculate that, because you may see an interest rate and say, well, that's all I'm charging. But when you're charging front-end points in addition, that goes into calculation of yield and may put you over the usury law. And where they do have usury laws, again, sometimes it can be forfeiture of the loan and extra damages on top of it. So having a good understanding of that. Now, I realize that relates a lot back to number 3, the attorney, but you know, you don't want to be totally dependent on an attorney every time you do something that you have to call up, and you know, they usually bill by tenth of an hour. So my attorney in Alaska, if I call him up and say, hello, good morning, I'm going to get a bill for about $30. So you want to have a certain amount of knowledge yourself so you don't have to call on every little detail.
Yeah, some questions came in using the chat box, which is great. That's one of the best reasons to attend these events live, is you can get your questions answered. And the questions are really related about how do you find a local attorney who specializes in lending. And I think one of the best places is to start with a reputable title company, because you're going to want to get the title company to record your documents and to close your transaction and to escrow the funds. And that title company works with a group of attorneys on a very regular basis that can. You don't want a young attorney or an inexperienced attorney just trying to learn the process on your dime. You want someone who does this so often that they can crunch out a set of loan documents from their paralegal in 10 minutes, and the attorney, you know, may not even get involved in the process because they've vetted their templates so well.
I would second that. Anytime I'm doing anything outside of Alaska, my first call is to a title company, and who do you use? And even on selecting a title company, I usually go through one of the senior people, the title companies in Alaska, say, who do you know in thus and such a state? So I have a name to call, and that person, and I say, well, who do you use as your attorney? And it's worked out quite well.
Here's an extra bonus tip that I learned through the School of Hard Knocks, which is title companies and escrow companies are just groups of people, and people are not perfect. And so people make mistakes, which means title companies make mistakes. And it is very possible for an escrow or title company to screw up your transaction in a way that can cause you real monetary loss. And I now, as a standard practice, before I send a check or a wire to an escrow or title company, I'll ask them for a copy of their errors and omissions declarations page. And it's interestingly enough that not all title companies are going to have an E&O policy. I mean, most will, but some won't. And the time to get that E&O policy is before they screwed up. Because if you're in a position where you're going to sue a title company for screwing up your transaction, they're unlikely to want to volunteer, you know, who their insurance carrier is and the amount of their coverage, et cetera. I want to know that amount before I entrust my money with the title company. And I haven't had any title companies push back on giving me a copy of their E&O policy.
Yeah, well, a legitimate one shouldn't have any problems.
Yep, that's right. Number 6.
Well, loan underwriting. Now, underwriting, of course, is just a big word for due diligence. And what I mean by that is you have to learn how to read appraisals. You have to learn how to read legal documents, credit reports. Now, we'll talk about later where in private lending, credit isn't as important, but we always get a credit report and usually it doesn't have so much of a decision as to whether or not we make a loan, but it's to maybe the loan to value ratio or the interest rate we'll charge. But credit reports can be useful because a person can have a poor loan score, the FICO score, but when you look at it, there's totally explainable reasons for it. They had a medical emergency, they went through a real estate crash in a certain market. Those aren't so bad. I mean, conventional lenders probably treat them the same, but what I look for in a credit report, for example, is evidence of character. Someone who's never ever paid a bill, they're probably not going to treat you with any more respect than they have other people. So I'm not so concerned about the FICO score, but looking at the nature of what the credit problems are. Being able to read a title report. They give you title report, but they're like any insurance policy. They exclude an awful lot. So being able to understand what the exclusions to your insured interest are, having some idea of what's involved in casualty insurance on the property that you're making a loan on. Unless it's raw land, you're going to want some type of casualty policy. So having an understanding of that, and all of those things go into making a decision: is this going to be a safe loan or not? So it's basically it's a due diligence process, but there are a number of things that have to be checked.
Something that's really great about having been a borrower in a private lending situation is following the actions of the lender to see how they underwrote my loan, what documents did they request from me, and then there's a really powerful letter that the lender will usually include, which is the closing letter, saying I'm willing to close this transaction subject to you issuing me a first lien on the property and removing items 9, 10, and 11 from exclusion of the title report. And Ken, talk about the difference between like the preliminary title report, which has exclusions on it, and then you as a lender getting those exclusions off the preliminary title report so that the title insurance is as clean as you want it. For example, maybe there's senior liens on the property, or maybe there's other chains of title issues that you might want to be cleaned off before your loan is funded.
Yeah, a lot of times the loan you're making is paying off another loan, so it's not an issue, but you got to be sure that the title company pays it off at closing so that you're in first position rather than second.
Mm-hmm. Yeah, so it could be another lender, it could be mechanics liens or mowing liens or unpaid property taxes, etc. Well, what are some of the other things you look at in the loan underwriting process? When you're making a decision, a good business decision, should I do this loan or shouldn't I?
Well, one thing I like is an experienced borrower. By that I mean a lot of the private lending is you're making to people for investments because, like I said, rule number 2 is don't loan on an owner-occupied home. So a borrower with experience, to me, is important. Have they done deals before? Have they been successful? That's a little harder to verify. I mean, there's not a national resource that you can use like a credit report, but is talking to them, getting an idea. So I will often ask for a copy of their professional resume and ask for addresses of other properties that they've done, and that always makes me feel better because someone who's been successful in the past is probably going to be successful again. Somebody, their first outing, I don't say that we won't do it, but I look at them a lot more closely. Like if they've never really done any real estate investing, I want to know, well, what kind of education do they have? What type of work do they do? And I'll usually do a personal interview with someone like that and try to get a feeling as to whether they're likely to be able to succeed in what they're doing. In many ways, I think that's more important than a credit report, really, on private lending.
Yeah, knowing who your loan money is going to. Yeah. Number 7.
Number 7 is kind of a technical one, but it can be an expensive one if you violate it. And this is a little thing that people aren't aware of. There's a tendency to believe that, well, I've made a $100,000 loan on this property, and now I've got a $100,000 insurance policy. If the place burns down, I'm okay. You're usually okay if it's a total loss. But if you're in a metropolitan area which has a good fire department, most times there aren't total losses, there are only partial losses. And within an insurance policy, almost all insurance policies have something called a co-insurance clause. And what that says, if you don't carry a certain percentage of the replacement cost, in other words, the cost of building a new replica, that you become a co-insurer. And what we have now pretty much throughout the United States is a lot of properties that the current value is less than the cost of building a new replica. So you might have a $100,000 loan on a property that is worth $150,000, but the cost of replacing that may be $300,000. So if you had a $50,000 loss, where only half the building burned down, say, the insurance company would say, well, you're only carrying $100,000 and the replacement cost is $300,000, so 100 divided by 300 is 1/3, so we're going to only pay you 1/3 of your $50,000 loss. Well, in that case, invariably you're probably going to have a default and a foreclosure, and you're going to get back a damaged property. The other thing that's important to make for sure that you were named on the policy is mortgagee. Just the fact that the person has a policy doesn't necessarily cover your interest unless you were named as a mortgagee on the policy. So it's kind of a technical issue, but it can be, and hopefully something you don't run into very often, but it does happen occasionally. So it's an important thing and can cause a big loss if there's a loss on the property and you're not insured.
Ken, when you are the lender and you're named at the closing table as mortgagee on the policy, if that borrower ever cancels their insurance or reduces their coverage, are you automatically updated by the insurance company of that change?
Well, we're supposed to be, but sometimes that doesn't always happen. But yeah, the answer is yes, supposed to
be. Yeah, so that's really important when you close. Make that named insurance part of the closing package, because I've seen borrowers do this before, where they close and then they get the insurance after closing, and it's just a small risk. Number 8.
Well, this one kind of follows up really number 2. But it relates to all types of properties. If you've got a distressed borrower, in other words, somebody's losing a property and they come in, they want you to refinance their loan so they don't lose the property, you have to really get at the heart of why are they distressed. Is it because they're a poor money manager, or was there just a temporary situation that is now cured? Because if you don't cure their problem, your loan doesn't resolve the problem. You're just going to become, they'll delay their issue 6, 8, 9 months, and then it becomes your problem. So I'm not saying that there aren't situations where properties are in foreclosure and you make a loan to salvage it, because we've done this and some of them have worked out very well, but you really want to be sure that you're solving their problem, not just postponing it.
That's great advice.
This one is a really critical one. It's one that, well, I guess they had credible plans at the time, but we ended up with some problems because of a change in the market. We did a number of loans in 2006, 2007, which their repayment plan was, well, going to fix the property up and then refinance it. Well, then financing changed. 2006, 2007, if you could fog a mirror, you could get a loan. But by the time they got the work done, we got into 2008, 2009, it has become a very, very difficult market for refinancing properties. So they haven't been able to repay. Now, what we've done with people who are good borrowers, we've rewritten loans, but the problem is we've had to drop the interest rate in some cases because of the fact that when you're loaning at 12, 13%, when somebody's doing a flip, that's a typical rate, but it's pretty tough to hold a property and get enough rental income to pay that type of interest rate. So we've had to write down interest rates on some of these because they haven't been able to refinance. Now, in that case, they may have had a credible repayment plan at the time we made the loan, and conditions change. But you try to look out to the future, and is it likely that they're going to be able to pay you back based on their plan? Is it logical? If it's you're making a loan now to a flipper, and you're maybe loaning say 60%, and they're going to fix it up, and then the value is going to be a lot greater, where your loan is, by the time they get the property improved, it may be only 50%. It's credible to believe that they're going to be able to refinance and pay you off. But if your loan is still going to be 80% at the time they get the work done, that would not be a credible repayment plan. Also, this is where credit comes in, is that the credit may not affect your decision to make the loan, but if their plan is to borrow from a conventional lender to repay you and they have poor credit, they're not going to be able to get a loan, so that their only repayment plan is going to be able to sell the property. So one of the things I've asked for now is, what is your plan to repay the loan? Where do you expect to get the money, not just hope for it? And that is particularly important on short-term loans. Now, if you're making longer-term amortizing loans, it's not as big an issue. But if you're making 1, 2, 3, 4-year loans, make for sure they have a plan that at least passes the smell test.
Yeah, it's very important.
Number 10 is remember Commandment number 1. I just can't emphasize how important number 1 is. And I might add an 11th one. I had this list reviewed by several of my competitors who also do private lending, so it's not just totally my list. But one of the guys said is number 11 is do as I say, not as I have done, because all of these have been learned through painful experience. I think between the three of us, at one time or another, we've all violated one or more of these commandments, and every time we've done so, it's been expensive. So this is truly something not developed on a theoretical university campus. This is something that's been learned through the School of Hard Knocks.
Something, Ken, that I would add, maybe number 12 to your list, which is if you're just starting out as a private lender, having the legal advice and the tax advice is really a small component of what it takes to be successful. That's kind of the mechanics of it. But having a mentor to review your business plan, I wouldn't necessarily take an attorney in my business plan to get business advice, right? I'm going to go to someone like you or myself and say, I'm thinking about lending money on this property in this LTV, and here's the business plan. Could you help me with my underwriting? You and I aren't going to come up with their loan documents necessarily and help them with their RESPA compliance, but we could say, you know what, I would do a lower loan to value, maybe a higher interest rate. Maybe if you consider doing a fractionalized note, maybe you do, a first and a second mortgage to the same borrower with different maturity dates and different interest rates. There's so many variables that go on, and I would just encourage someone to find a business advisor in addition to their legal advisor.
I would agree on that. There's also some good books written on it. One particularly good one that I like is called Smart Trust Deed Investing in California by George Coates. It's out of print now, but you can still buy some on Amazon. And while it's about 20 years or 25 years old, most of the, there may have been some changes in legal decisions since then, but the basic fundamentals of lending are still valid. Mm-hmm. And so, getting those, it'll help you develop a business plan. But I totally agree with you, David, and also understanding your risk tolerance is important. Some people are willing to make a second loans, others just aren't willing to take that risk. We place loans for private investors, and we have quite a range of what people will loan on. I've got one guy he'll do anything if the yield is high enough, but I've got others that say, hey, I'm most concerned about getting my money back, and I never want to be over 50% loan to value ratio. Mm-hmm. Well, it's tough to make loans at 50%. I mean, occasionally we do, but usually what we do is we make a loan and then put them in for a preferred fraction, the way of doing. But understanding your own risk tolerance, what types of loans you're going to make, how much you're going to have in any particular loan, what geographic areas are you going to do. Business plan is incredibly important, and I agree a lawyer won't be much help on that, but part of your business plan should be finding a lawyer that can help you on the technical aspects.
Yeah. Yep. So just kind of wrapping up the business perspective of it, why would a borrower pay high interest rates, right? A conventional lender is going to, charge 5. Why would someone borrow from you at 10? And a conventional lender has got a very narrow box for people to fit in. Either the property is going to be perfect, the income of the borrower has to be perfect, or in a commercial loan, the income of the property has to be perfect. And then the credit of the borrower, or in a commercial loan, the credit of the tenant has to be perfect. So if one of these legs of this three-legged stool is broken, then a conventional lender isn't going to lend, but it doesn't necessarily mean that the risk has gone up, right? As a private lender, you're primarily looking at the collateral for repayment. If I don't get repaid, am I going to be okay? Because I can happy to foreclose, take the property, and the property itself is worth more.
And that's rule number 1 and number 10.
Yes, that's it. So some of the advantages of using a private lender, right? So we're going to bust this myth that higher interest rate automatically means higher risk, and that isn't necessarily true. There's oftentimes many reasons why someone would choose a higher interest rate. The lender can be more flexible, they can close faster. Private lenders can use common sense in their underwriting versus just this narrow box. Diverse asset types, right? Private lenders might lend on construction or vacant property, whereas commercial lenders or conventional lenders might only want full property or different types of properties. Right? Land is not a very favored asset right now in conventional lenders, but at the right loan to value, there should be a private lender willing to do that deal. So lots of reasons for using a private lender, and the reasons for being a private lender: passive returns. You get cash flow from your investment. It's more secure than being the owner of the property. It's more oftentimes that the property owner gets sued than the property lender gets sued. This last market cycle, you saw a lot of conventional lenders getting sued because that was just a very popular thing to do. But over the great span of history, being a lender has been relatively a secure position. And with today's interest rates and CDs and bonds, if you're looking for income, being a private lender secured by real property is relatively secure, and the yields are far outweigh what the alternatives are. Even, I have a lot of, conventional asset managers or financial planners, advocating municipal bonds. Well, municipal bonds are generally unsecured, and what if you had made a purchase a municipal bond from the city of Detroit or from the city of Vallejo, and those cities declare bankruptcy, and your bond was only secured by the faith of the people of that town, right? There was no real collateral behind it. Versus when you're a direct private lender, you can touch and feel your collateral, you can understand the collateral, you have control over the collateral, and you could be using lending loan to own. That could be a method of investing. And most importantly, if you've got the help of an advisor or a broker such as Ken or myself, we can make the process very, very simple for people who have money to lend and they want to lend that money. If you're
One thing,
interested, yeah, go
I
ahead.
thought about is also it's a great source for investing pension funds. It's a little more difficult sometimes, even in a self-directed IRA, to get an equity property, but virtually every trustee is real comfortable with loans. So it's a great way of investing your pension assets.
Yeah, I totally agree. And there's several videos on my website where I talk about the how to allocate your portfolio of ownership of property versus ownership of IRA assets. And if you go to hasslefreecashflowinvesting.com, you'll hear a lot of my opinions on tax structure. And I definitely want to own paper in my IRA, and I want to own real estate outside of my IRA. And we don't have enough time to go into the why, but I love owning notes in an IRA. I've written an entire book called Hassle-Free Cash Flow Lending. It's a free book, and it is lengthy, and it has a lot of meat and a lot of definitions and a lot of strategy in it. If you would like to own your very own copy of this free ebook, visit hasslefreecashflowinvesting.com. Go to the ebooks tab, scroll down to where you see the Hassle-Free Cash Flow Lending ebook, and you can put in your first name and your email, and that book will be emailed to you right away. If you're looking for the direct URL, it's on your screen right there. Awesome ebook. Highly encourage you to read it. It's no holds barred. It's pure content. There is no upsell in that book. If you're looking for investment opportunities and additional investment training, I encourage you to visit my website, hasslefreecashflowinvesting.com. And Ken is a very creative investor, and he's got a fantastic website at kengain.com. I want to thank Ken for being a fantastic mentor on today's call and being very generous with his time.
Thank you.
Yeah, thanks so much, Ken, for being here. And I want to thank everyone for taking the time to invest in your financial education and invest in your financial future. And I look forward to the opportunity of speaking with anyone who is looking for opportunities or more coaching on private lending.